before we head on out of here. So thanks to everyone for coming. It's a nice session here, a little bit about cryptocurrency and risk. So I don't know if those are synonymous or not, but got the right panel here for that. Mr. David Baumser. David's a dear friend of mine and colleague for many years of SAP Pioneer. He's the head of our U.S. core banking and mortgage. Joined today with him is Mr. Joe Medioli, Anchorage Digital's growth and strategy lead client partners. And then Mr. Stephen Taylor, longtime friend of SAP, Chief Information Officer with Vast Bank. So we'll have a nice fireside chat. So I'll turn it over to you, gentlemen.
Thank you.
Thanks, Lance. Before we begin, does anyone in the audience own crypto? For those who own it, do you keep it in the bank? Do you keep it on your thumb drive in your back pocket? Or where do you keep your crypto? Exchange? Okay, very good. So we're going to start with a couple of questions. Let me ask Joe about Anchorage. So what is a crypto-native digital bank?
Yeah, so a crypto-native digital bank is a little bit of a novel concept in this space. Anchorage in particular started out as a security company, a state chartered trust, and then in January 2021, we became the first federally chartered bank, specifically and purposely built to hold digital assets. We provide custody, settlement, staking, and on-chain governance, all within an OCC charter. So we were kind of born and raised out of the security world and from crypto into traditional finance.
So what type of customers does Anchorage target?
So we built ourselves out as purely an institutional facing business. So we are very focused on infrastructure. We look at hedge funds, wealth managers, alt funds, sort of traditional institutional players in financial services, but being a crypto native ourselves, we've also been very early in supporting protocols and other sort of layer one technology companies, mining firms, you name it. So very much institutional focused. Really trying to bridge that gap between sort of the crypto world and traditional financial services.
Thanks. Stephen, I've been working with Vast for about 7 years, and it started as Valley National Bank, a community bank in Tulsa, Oklahoma, and you rebranded yourself several years later as Vast and sort of did a transformation. Tell us a little about Vast's business in crypto and how you guys are unique.
Yeah, so we, as you mentioned, we were Valley National before. We've been a nationally chartered OCC full-service bank for 40 years. We're based in Tulsa, Oklahoma. We are national, so we do service customers in all 50 states and U.S. territories, Guam, Puerto Rico, et cetera. We've been involved in the full spectrum, so retail bank as well as institutional banks, and mostly in the traditional banking space, meaning mortgages and lending to commercial entities. We decided to get involved with SAP when we did our core conversion. We were the first bank in the United States to implement the banking core in the United States, so SAP transactional banking. And we decided to get into cryptocurrency about 2018. But we knew that it wasn't something that we could do as part of the national charter and the regulated process. We wanted to do it in the right way. And so when the interpretive letter that came out that said that we could perform that activity, we had been involved in kind of building out the technical approach to that. And as of today, we're still the only kind of retail bank that's launched end-user based products. We've been in that process for about 1.5 years and still building out kind of our technology platform for that.
Well, great. Here's a question for both of you. So aside from the market risk, what are the various risks that holders of cryptocurrency and other digital assets need to consider? Because we've seen a lot in the press lately.
Yeah, I'll kick us off. One of the big parts of this, unfortunately for those of you in the audience holding on exchange, is that, one of the biggest risks is understanding where your funds are and how they're kept and how they're safeguarded within regulated infrastructure. Right? In the end, you can think of the equivalent of, holding assets on thumb drives as the same as putting cash in a mattress, right? It's there, it's safe, but, until it gets wet, until there's a fire. And so when we think about mitigating these risks, you look at the same way that you would protect your assets, your family assets. You put them in a regulated institution that themselves have due oversight, that are held to certain standards that across industry are held to, and you have to look at those risks top to bottom. With crypto, you have the added layer of also the security infrastructure, right? How do you prevent hacking? How do you deal with business continuity, resiliency, and so forth?
Yeah, that's a great introduction to, I mean, the idea of having a trusted custodian. And we talk about this a lot in some of our public things we do with retail consumers, because a big part of our base are retail consumers. And, you know, in the crypto industry, they talk about the $5 wrench problem, right? And that's, what are you going to do if you have a bunch of crypto on a thumb drive or on a hard drive and somebody comes in with a $5 wrench and threatens to hit you over the head if you don't give it to them, right? So it's those problems are legitimate and real, and the reason why large wealth is stored in a trusted custodian. And, you know, traditional fiat terms, that's in the vault in the bank. And, you know, a bank like Anchorage is a great custodian type of a resource to be able to put your trusted stuff in a secure way. The challenge is that there's a misconception in the industry, you know, the problem where it's who is controlling it. And I think there's a misconception. People trust the control around that those assets with their US dollars, even where that's a lot of their money, but they don't on their crypto. So there's a very interesting dynamic happening right now in that space. The other problem that we see from a crypto risk is what happens if the person who knows where the keys are passes away. How can their family claim those assets? And the reality is, if it's not in a custodian, you probably can't. And there's actually large numbers of crypto that are now permanently gone, right? They were initiated on the blockchain, the keys are lost indefinitely, and those cryptos are just gone. So their families can't actually benefit from that.
Isn't it in the UK, you hear about that man who wants the dump searched because he threw out his hard drive and then realized what's actually in there?
Yeah.
That's
It
right.
was hundreds of millions
There
of
was a
pounds. or
CEO who passed away with keys to hundreds of million dollars in assets. Yeah.
Yeah.
The stories abound. Yeah.
Yeah, and so those are real, and those are the problems traditionally that were solved by banks. I mean, it's you store value, you trade value, and those are core services of a bank. So it's applying those same concepts to crypto is a lot of where the value can be added.
Here's a question I'm sure is on everybody's mind. Both Bernie Madoff and Sam Bankman-Fried built their reputations for being very, very close to the industry and leading voices of industry regulation. Yet we all know what happened. What can FSIs do and what can consumers do to make sure that their assets are safe?
Well, I mean, sort of building on what Stephen was just saying, I mean, think about the infrastructure required to be a bank, to be a custodian in this case, right? Like, so when you're thinking about who you partner with to put your own assets, either as an institution or a retail customer, right? Understanding what goes into that build, and it's not just a personal trust question, it's are you held up to a certain standard, right? What does actual resiliency mean? Do these people have public audits, right? You have to look at that sort of full stack. And then the other side of this, I think, is regulation, right, which is continuing to evolve in this space. You know, a lot of the, Sam Bankman-Fried example occurred in offshore jurisdictions without a regulatory regime. Madoff didn't, but now we have an updated and now recently even more updated custody rule that was previously called the Madoff rule. So there's a little bit of a push and pull in this space between regulation and infrastructure, but you can't get away from that if you take a regulation first approach and a basically customer first approach.
Yeah, in some of those cases, people, like in the Madoff case, are doing things that are explicitly illegal, right? They're doing things that they shouldn't have been doing. And other cases, like the 2008 mortgage crisis, people were doing things that were legal but extremely risky, and doing those and taking those risks with customer funds. So I think there's a couple questions, like in Sam Bankman-Fried's case, where FTX took those funds and they behind the scenes rehypothecated them into other areas, and then they did that to get leverage to get a return. So if you think about a yield-based asset, any yield-based asset is going to put funds at risk. And it's no different than traditional banks where you're doing spread on margin-based business, right? So if you take a bunch of deposits and you lend those out and those loans go bad, you're putting that at risk. The OCC, as part of our regulatory agency, they control the rate of how much of their customer funds can you put at risk, what are the things you can do, all the CECL rules, all those things exist to protect consumers in that space. The lack of the regulatory bodies to provide those governing frameworks around crypto are driving people to participate, who want to participate in crypto, to take risks with unregulated entities. In my view, the fact that they're not moving fast enough is what's pushing people to do unrisky behaviors that enable that type of event to happen.
Yeah, I think actually that's a great point. I mean, thinking about like what it means to be a bank, what it means to be a trust, have fiduciary. I mean, even by definition, an entity like Anchorage, our customer assets aren't on balance sheet because we can't legally rehypothecate them. Right?
Right.
Those assets are those assets. For customers that use us as an on-ramp from U.S. dollars into crypto, we're required to have a fiat banking partner that is FDIC insured, right? There's layers of control there to protect that type of activity.
And because you're a regulated entity, you're not allowed to do the types of things that FTX done because they're not regulated in that framework. And that's where not having those good regulatory frameworks put customers in the regulators in this case are actually creating the danger for the customer.
And I think the other element to this, which sort of gets to your point about being able to do things that you can't do vis-a-vis FTX is, for at least with Anchorage, right, we're not an exchange ourselves, right? We're a custodian. What's interesting about a lot of how crypto is developed is that we have this world of custodial exchanges, which when you look at traditional financial services, like nobody puts their assets on the New York Stock Exchange for custody. That's not how you do things. And
right.
So we're in this funny place right now where you can custody assets on exchange because that's how the market's built out. I think over time, what we're seeing and what we've seen with FTX and what we're seeing with others is that decoupling is going to be sort of a natural progression over time to more mimic traditional financial services to take advantage of the controls that exist in that space, separating custody and execution.
One thing that usually concerns me as a longtime banker is, it recently came out that Coinbase via their 10K disclosure and Celsius via a judge's ruling that most cryptocurrency deposits at those firms are actually owned by the custodians, with the customers being last in line for repayment.
Yep.
So, in case of bankruptcy. So how can investors maintain ownership of their crypto assets and not worry about having to fight to get them back? Because I think that's a huge concern right now with a lot of people using. We talked about exchanges before, That's why you have this whole kind of I want to hold the crypto myself movement.
Well, I think that as a consumer, that's your option, right? So as a consumer, you pull it off of the exchange and you put it in a custody service, whether it's self-custodied or it's custodied with a custody service partner. I think the reality is the custody service partners that are available for retail consumers is still there aren't very many, and there aren't really ones that are safe or regulated either. So that's where we want to be able to perform those functions, but we can't because of some of the constraints. I do feel like that the option specifically on Coinbase, what we did and what I think institutions, other banks can do to protect their consumers is enter the right agreements. So we actually did a separate agreement with Coinbase. Coinbase is our exchange partner, so we're not an exchange. We're very clearly in that same separation. We're not an exchange, we're a custody partner, so we partnered with Coinbase to be that exchange. In our exchange agreements, we actually have a separate institutional agreement. So it's not the standard agreements. Those coins and other pieces are explicitly in our customer's name and declared exempt from bankruptcy filing. So we went through a very lengthy legal process to make sure that our customers were set up and protected, which is different than if you're a retail consumer of Coinbase.
If I recall correctly, you work with 3 keys with Coinbase. Did I get that right?
Yeah,
As opposed
it's
to
a
traditional
multi-key.
two?
Yeah, we do a multi-part key. We actually do multi-sig now, which took a long time to implement. Frankly, it was pretty painful to get it done. But yeah, we did a more thorough process that actually give us control directly of those digital assets.
Yeah, similarly, right? I mean, we talked about this a moment ago, but Anchorage being a trust, naturally bankruptcy remote in that scenario.
Yep.
But at the same time, right, we have also built out, we have our own affiliate partners that are agency brokerage services. So you're using an agent to go execute with liquidity partners on behalf. And then even in advance of FTX, we've been very focused on building out sort of better settlement infrastructure for our partners. On the one hand, to eliminate the sort of counterparty settlement risk that you naturally have by having to pre-fund on an exchange when you're trading on exchange, or if you're trading with an over-the-counter desk, to have to pay for your assets before you receive them. So how do we improve settlement risk across the board, eliminate DVP? We're very focused on building out that kind of product infrastructure to help sort of evolve the industry away from that type of risk, frankly.
Mm-hmm. So how do you win over if it's not my key, it's not my crypto crowd with custody services? Because I'm sure a lot of people in the room kind of feel that way, and I know a lot of friends who do their own mining, it scares them. They don't want to turn over their keys to anybody. Yeah. How do you kind of make inroads with those guys with custody?
Well, at the institutional level, I mean, a lot of that has come down to, one, our federal charter and the infrastructure and the regulation and the oversight and the ongoing sort of audits that are supported, or that support that build. But it's also the security stack that we've built. I mean, you mentioned like multi-sig. You know, one of the kind of core tenets of Anchorage is that we actually have a very unique security model from the ground up where, you know, we don't even have a concept of passwords or usernames, right? All of our access to customer accounts is done by, you know, biometrically, you know, authenticated access, using voice prints, face IDs, you know, all, first of all, to enable, to validate, you know, ownership of a device in terms of, you know, how do you create access, and then also to validate intent of a transaction, all before you get any sort of connection with the underlying private keys. So we've built a very deliberate security architecture to create that kind of safety, and then therefore sort of mitigate some of these concerns that, you know, not even Anchorage employees can move these assets. These are your assets. You have the access.
Yeah, one of the things that we're also doing is an education campaign. So we're just trying to help educate people. One of the things we found is the most helpful is asking them questions that lead them to answer the questions themselves. So the example, for example, you know, is where ask them, well, what are you going to do if you have it on your thumb drive and, you know, you pass away? Like, how are your kids going to reclaim those pieces? So just simple questions that there's not a good answer for in those processes, and asking the same question, because most people forget that crypto is fungible. Like, just because you deposit a particular Bitcoin doesn't mean you get back that same Bitcoin. Just like if you deposit $100, you're not going to get back the same dollars, you just get the same value. So just walking through those things with people it just takes time.
Yeah, that's a great point. Even with my own group of friends, right, reminding people that if you spill your coffee on your desk and that's where your Post-it note with your hash is, there it goes, right?
Right. Yeah.
So Joe, how does Anchorage's digital asset custody services differ from those provided by fintechs and other cryptocurrency service providers?
Yeah, I touched on this a moment ago. One, like really at the core of this is our security stack end to end. You know, early on, and you know, it's still sort of a facile model to talk about the difference between something like cold storage and hot storage, right? Cold storage traditionally being the equivalent of a thumb drive that's in somebody's, you know, desk, and you know, hot storage being sort of a, you know, online connected wallet. What we built and what Anchorage really is focused on is this concept of smart storage, where we have all of the private keys. We have all of those actual wallet addresses and private keys in air-gapped offline hardware security modules. So we have this concept of cold storage built into our infrastructure, but the way our security model works, we have extremely high latency to be able to withdraw those assets. So, you know, in the early days of crypto, a lot of the institutional custodians said, great, we have this, it's very safe, it's, you know, cold storage, but it's going to take like 24 to 48 hours for you to get your assets out. You know, our model is built around actually eliminating that and further reducing the latency while still maintaining that, you know, offline-like security and storage.
Stephen, how does Vast sort of see itself set apart from your crypto services versus the rest of the industry?
Well, especially for our customer facing, I think one is having it fully integrated into the rest of the banking stack. So as an example, I actually had a case in that this actually happened with me. I have my card separate, so I have my main bank card, and then I have my crypto enabled bank card. And I didn't have enough money on my crypto bank card when I stopped to get gas, so I opened my app and I sold some crypto and then bought the gas right there, right? So it settles, everything's 100% real time in the transactions because the products are fully integrated. We use the tagline, you know, making banking surprisingly easy, and so we're our purpose is to integrate that and do that with crypto. So crypto is a pretty daunting thing for a lot of people when they first get into it. So it's integrating the user experience to make that entire process as seamless as possible is a core differentiator for us.
And Stephen, do investors have the same level of protection for cryptocurrencies versus other types of digital assets like NFTs, for example?
So I think the short answer is they can actually have more. So the security infrastructure in traditional banking is actually surprisingly bad. The crypto security is actually much stronger in a lot of cases. And the NFTs and other pieces that are all stored on the blockchain, they're all fairly robust in the way that those work. The challenge is that over time, a lot of other things have complemented in the banking world that have added that security infrastructure. Now with NFTs and other pieces, right, people have not really figured out how to avoid the phishing and the scamming and all the other stuff that's happened. And so a lot of the fraudsters really prey on a lot of the crypto folks. And so I think over time, the infrastructure that is more advanced in that space will actually make digital assets even stronger case for storing and value of money.
Do you both see NFT volumes growing, or do you see it kind of leveling off recently? Or?
I see it growing, but I think it's going to be in specialized use cases. For example, I do see, I mean, if you just think of NFTs as, being non-fungible, they're specific to a specific asset, use cases like replacing titles for land and property with, the courthouses having chained NFTs would completely revolutionize the way, property management work. We're already starting to see that in New York and a couple other areas where they've been testing it. So I see a huge uplift in NFTs in that kind of asset digitization and tokenization space. That's my
view. I couldn't agree more with Stephen. Yeah, I mean, even my shrug was thinking about the current world of NFTs. As
Your pink elephant and that stuff?
Exactly, versus
right.
a world where you're looking to, tokenize commodities, right? And you need to track one-to-one, a certain underlying asset. Like that is the value of something non-fungible. Or you add features and then you talk about things like title searches, right? Like I think the world and the legal infrastructure around that still has a long way to go. But fundamentally, I think we're going to see that grow as a function of other assets sort of becoming tokenized and taking advantage of the digital asset technology.
Yeah.
So Joe, just to build on that, how should investors and advisors look at the digital asset space to better manage their risks?
Yeah, so I mean, this is actually it's a great segue from that comment because, today, right, it's very clear, right, most of digital asset trading is really focused on these highly volatile assets, right, your Bitcoin, your ETH, your altcoins, in a world where you have that as your option and you're comparing that against your traditional, advisory portfolio with securities, right, you're going to have a very small allocation of something that volatile, right? First step, obviously, is if you're going to put money into this, you have to go with a registered investment advisor or wealth manager who actually is using a qualified custodian and has that infrastructure to keep your assets safe. But then over time, as more of these equity-like products become digitized and get onto the blockchain, now you actually can have a holistic portfolio that's self-hedging, right? You have volatile assets on one side, you have tokenized funds on the other side, and then you're actually taking advantage of some of the sort of infrastructure promise and efficiency that sort of comes with digital assets.
Yep.
Stephen, how do you see regulation impacting the industry? Because all you ever read about is new regulation, and regulation in the U.S. is like a pendulum. Right now, it looks like it never rests in the middle. Right now, it seems to be on the extreme side.
Yeah, I think that ultimately the people who take a regulatory first program end up winning in the long run. So in the short run, you have people who are unregulated entities that take advantage of a temporary market and a blip. But in the long run, regulated industries, the people who are partners with the regulators will win. I think the biggest headwind that we have right now is that the regulators are not educated. So we have a lot of work to do to really help the regulators get up to speed and understand how to apply positive regulation and not just to be stifling of the industry, but how do you do it, how do you perform and get the uplift that you can get from digital assets and the value in the market without stifling it at the same time. And that's a balance that tends to, as you said, tends to swing a pendulum from one extreme to the other, and right now they're in a suppression mode more than an enabling mode.
And I think to that end, right, a lot of the suppression that we see right now is not regulation, right? It's done via enforcement, it's done via conversation, and I think that's the other challenge as well, which is that there's a vibe, a feeling, right, of lockdown, but it's not been publicized, right? There's not a rules of the road that have been documented that folks can line up with. So I completely agree, right? Reg first, but we are in a challenging environment where there isn't anything on paper, and therefore you're relying on enforcement to guide your actions.
So this next question is for the both of you, and this I'm sure is on everybody's mind. When do you see investor euphoria returning to the cryptocurrency markets, and what would be the drivers?
Well, I think the easy answer is skyrocketing prices, but aside from that, right?
It's a chicken and the egg thing,
Right.
What's going to make them skyrocket?
Yeah. I mean, I think, look, right, you know, it's what makes anything skyrocket is demand. And a lot of that demand comes from retail, it comes from wealth managers and their underlying investors. And so, you know, as this infrastructure is getting built out and there are safer players, I think that's one facet. The other facet is, you know, we are going through a bit of a winter, and that winter is separating a little bit the wheat from the chaff, right? There are a lot of bad actors who've always been bad actors who are now out of the marketplace. There are companies that weren't bad actors but were improperly managed who are now out of the marketplace. And so you're going to have a group of companies and providers and infrastructure that are just better built, more resilient, and more able to service the market in a safe, compliant way.
Yeah, I'm hoping actually that the euphoria in many cases doesn't return. And what I mean by that is that I think it's a lot of the euphoria that was there before was really just greed and FOMO, right? So everybody saw these prices going up and they're like, oh my gosh, my friend just got $1 million gain from, you know, this Bitcoin investment that he did. I don't know what Bitcoin is, but God, I got to buy some tomorrow, right? And so they were just throwing money in their really risky way at things that weren't healthy. And a lot of the value wasn't really earned from the platforms. So if you're just buying and expecting it to go up over time and momentum, like that's not sustainable, right? And it's not a market. So what I would really like to see is good industry adoption and use and put it to work, right? So if we start seeing payments with Ethereum, Ethereum's going to go up in value because it's going to have a valuable use and process. If we see, you know, Avalanche adopted for its, you know, chain for title chaining, then we're going to see a huge increase in value of that. That to me is when we start to see it. It's when the industry start to find real use cases to apply the technology to real business problems.
And you know, I think the other side of that as well, on the sort of, we'll call it net new asset side of the world, right? Like interest rates with where they are means that capital allocators are being a little bit more careful about where they're throwing investment dollars. And so I think there's a little bit of this as well, is that in this market, you're going to naturally see fewer massive high valuation companies that have got a ton of capital as a function of FOMO, and now a little bit more diligence on where those early investment dollars go, which will hopefully itself lead to better players down the line.
You mean I can live with my 5% CD at the savings bank now?
Right. Yeah, I mean, if you take, I mean, that's actually what got the FTX in trouble, right? Is it not only were they doing it offshore, but they were, the intent was just like any bank does with leverage with spread margins where you lend against deposits. They were saying, look, we can go and we can stake these, or we can do even more interesting things on the crypto on the side with arbitration between markets and all this other stuff. And we can get a 30% return on those assets, and then we can give the customer back a return, right? So they had their staking pool that was a guaranteed 8%. Well, you can't get consistently 8% without a lot of risk, right? So and they were putting all their customers' funds at risk, and that's what. So the real question is how can we as financial institutions create sustainable, moderate risk, low risk, and give people a return and give people a yield that's reasonable and not just do it, you know, in a way. But that's why a lot of these regulatory agencies have created those frameworks to be able to create that in the first place, is how do you do that?
One closing question. What are your thoughts on the recent press regarding Silvergate Capital, and what do you two see as the implications of that?
I mean, I think the implications are unfortunate in that, you know, it's another sort of very public setback from a, you know, certainly from a PR perspective from the industry side. You know, on the other hand, right, it's going to give more opportunity to other players, you know, traditional financial services players in the marketplace to actually take on and think through what does it mean to bank crypto, what does it mean to support this industry and these customers in a more safe way, and hopefully will lead to less concentration risk in one player like a Silvergate.
Is that a proliferation of the VAST model is what you're seeing?
Yeah, our model, hopefully. Yeah, so, I mean, we see it as a potential upside for us. I mean, we are actively engaging with many of their existing customers, you know, to become a bank to fund them. But I think that just like historically we've been in Oklahoma, and a lot of our commercial clients have been in Oklahoma, so we're oil and gas oriented, right? you don't want all oil and gas customers, because if the oil and gas industry hampers, that hurts you. And there's a reason that banks have concentration risk profiles, exactly as you mentioned. So I do think that Silvergate had significantly, almost 100% concentration in this one industry. So when you start to have challenges, that is what that's the reason that those rules exist. So I'm a little surprised. I think a lot of us actually kind of anticipated this. We've been talking about it probably for 9 months, that it was both Silvergate and Signature are so heavily concentrated in a particular industry that it is a dangerous thing for them. For us, though, I think that there were some unique, the reason that it was so concentrated, they had created some unique products. And I would like to see us jointly as an industry create services that allow those real-time fund movement and settlement movements as an industry, instead of having it all dependent on a single player. So hopefully we'll see that.
And as a user and a partner with fiat custodian banks for those rails, that's what we want. That's what we look for in partners as well,
Yep.
right? Who can be a long-term strategic partner with diversified business model
Yeah.
that is also able to participate in these types of networks.
And hopefully the people that are doing that are running SAP Pioneer's banking products, so you can have a real-time platform to base it on,
heard it
right? Yeah,
Yes, with virtual accounts.
with virtual accounts,
Virtual accounts.
please. So-
Really
Lance,
good
do we have
plug.
time for maybe a question or two?
Oh, yeah, no, definitely have a little time for a question. Any questions out there? Come on, this is a really good discussion. Any questions going once? I've got one, of course.
Go, Lance.
Help us get our arms around the customer. I come with a very strong marketing background, right? So you bring a new customer in, I want to know everything I can about them, and perhaps cross-sell, deeper share of wallet. What are you seeing from a demographic standpoint? Are we seeing just all boomers jumping into this, or millennials? And what, if any, plans does your marketing team have to say, okay, let's offset the risk here and the loss of the balances by deepening our share of the wallet, maybe with DDAs or what have you?
The question was kind of on the consumer side. Do you want to take the institutional side
Yeah,
for
go
that?
for
Or
consumer,
go ahead.
yeah.
Okay. So for us, so we have now a couple million active accounts, and we've done a lot of market segmentation on those customer base. And the surprising thing that we found was that our customer base is predominantly women, which was a surprise to me. We were really shocked. Just because of a lot of, we've heard about crypto being kind of a male-dominated customer base. We're not finding that to be the case at all. So that was interesting. I think the second thing that we found was that there is no age demographic spectrum. It's pretty evenly distributed across the board. So in fact, one of our partners even has a child offering. So we actually have people who are even not of age that their parents are sponsoring accounts for them to do. The third one, which we found was interesting, a lot of them are doing it for investments. So whereas we're seeing a lot of general volatility at Coinbase as an example, you see their volumes are like huge swings day to day. We're actually seeing people just going in and buying them and holding them, which is interesting. So I think what that says to us is that it's the thing that's really resonating for our customer base is that it's a trusted bank. They're doing it through the bank because they trust the bank, they're going to buy it, they're going to hold it. They're not actively doing it as a trading. Like the people who are doing it with Coinbase or Kraken tend to be more gamblers, if you will, speculative trading. So whereas the interactions for our customer base seems to be more of an investment style of an approach. And the general feedback we've gotten has kind of borne that out. So it's different than what we anticipated.
It's interesting, dispelled some myths today.
Similarly, on
Go
the
ahead, Joe.
institutional side, as almost to your exact point about the buying and holding, I mean, that's why one of our kind of core customer bases and really where we're going to see this, we think, see a large part of the industry grow over the next couple of years is in the registered investment advisor space. So we look at this as institutional RIAs, but they're representative of exactly that type of customer who they want to have this as an allocation to their overall wealth management portfolio, and they need somebody like a qualified custodian in the back end to provide that infrastructure. On the other side of things, what we see a lot of activity from the get-go has been, OTC desks, market makers, right? Basically the liquidity providers to this market, looking to partner with us, again, from the safety and security side. We don't operate an exchange ourselves, and therefore we build out products to enable people to mitigate the risks they do have from like a counterparty risk, settlement risk perspective, you know, to the extent that they use our brokerage services. Even that from our perspective is, you know, riskless principle. So like we're not in the business of taking on that risk. We're in the business of providing that security, infrastructure, and market access to our customers.
All right, any other questions before we let these nice gentlemen go for the day? All right, hey, Joe, Stephen, thank you not only for your time today, but for being valued customers. David, awesome job as always, and thank you. So nice round of applause for our friends.
Thank you. All right.